Hey traders, Raghee here. I'm back for another free video. We're going to talk about Monday's picks. What am I looking at and why am I prioritizing certain stocks, sectors, and indices as we go into next week? This week, we heard from just about every Fed member it seems that there is, sometimes twice. We got Powell today, who sounded about as hawkish as he's sounded in a while, but ultimately, it does not seem that the target rate probability for a pause in June, pause in July, and the Fed pivot in November doesn't look like we've come off that expectation all that much when we look at the Fed fund futures. That keeps uptrends and the optimism surrounding at some point pause to cut, that Fed pivot, that keeps those hopes alive. Where is the best structure? It continues to be in tech. But why tech? Well, of course, we have the overall uptrend. Multi-trend is green at the trend and momentum level. Grab candles are green, indicating bullish markets, and we're bouncing nicely off the daily price movement range, our volatility-based support and resistance. And the uptrend is being fueled by the three cylinders, if you will, of this motor, and that's XLK, XLC, and lastly, XLY. XLY is the only one of these sectors that is not in an uptrend. But as we talked about, I believe it was last week. Yes, last week. Take a look. 10 days ago, my kind of warning, my heads up about the fact that Meta and Amazon were indicating that the path of least resistance was up for the NASDAQ. Now, why those two? Meta's the number one stock in XLC. Amazon's the number one stock in XLY. High concentration weighting demands that we are going to see more strength in those two sectors because of those stocks, and that in turn feeds the NASDAQ. So let's jump on back to Amazon. Amazon moving higher helps at least stabilize what has been XLY. Really difficult for XLY to turn into an uptrend, but we can see strength when Tesla and Home Depot get with the program. We might see a little bit more strength in XLY, which will only make the NASDAQ even stronger than it is. Maybe a sigh of relief coming with Tesla because of the new CEO for Twitter, and that presumes that Elon Musk will have more time to spend at Tesla and less time tweeting, perhaps. Now, we take a look at the XLY, and where are the levels that we need to see support at? Daily price movement range would dictate right around the 150 level. If we can maintain support there and XLK and XLC can move higher, just like we talked about 10 days ago, gang, very difficult for the NAS not to see a path of least resistance higher. The same is not true, by the way, for the S&P. So am I as bullish the S&P? Well, I'm not bearish. It's above the 200 propulsion. It's bouncing off the daily price movement ranges, the gray area of support, pretty darn nicely, but it's still stuck in a neutral environment. So why isn't the S&P, let me get rid of this vertical line here. There we go. Why isn't the S&P moving higher? Because it's being bogged down by XLF. Now, are there signs that XLF have, this group have recovered from the regional bank crisis sort of contagion? And what do we need to see in the XLF? Really easily said and done by support at the daily price movement range and a break higher through the 200 propulsion. Well, it's easier said and done if we have a few stocks that are helping us out. Let's take a look. Which stocks have to move higher for the XLF to move higher? Mostly Berkshire Hathaway and JP Morgan. Visa, MasterCard. Well, that's actually pretty good for XLF. That actually is very promising because Berkshire is in an uptrend. JP Morgan's above the 200 propulsion. Visa is above the 200 propulsion, and MasterCard is in an uptrend. As we get down the list of these stocks in XLF, the stocks are less weighted. So what happens is they have to make a larger price move to affect the broader sector in this case, to be impactful. By the time we get to Bank of America, we've dropped to 4.5%. Contrast that with JP Morgan at just over 9%, and you can see why it's far more important that JP Morgan, Visa, and MasterCard, of course Berkshire Hathaway, are moving higher. So this is going to be one way the S&P is going to start looking more like the NASDAQ. The other is healthcare, right? Now, when you're looking at your broader averages, and if you're not thinking about index sector stock, if you're not thinking about the broader average, then the sector in order of weighting, and then finally the individual stocks, it's not going to make as much sense why certain sectors impact certain indices and why certain sectors and indices are lagging. We've got to look inside them. By the way, remember, gang, and I get asked this from time to time, the world that we live in is a high concentration weighted world. A small number of stocks impact the sectors in a meaningful way. A small number of sectors impact the indices in a meaningful way. And even a small number of stocks impact the indices, right? So this idea that we care about all 500 of the S&P stocks is categorically unnecessary. All 100 NASDAQ stocks don't care. Dow 30, about 5 stocks really even matter because of their weighting. So don't worry about, well, do all 500 stocks or all 100 stocks need to move higher? They don't. High concentration weighting has made that as irrelevant as ever, and that's the world we live in. So why not trade the indices and the sectors with the actual composition that they're reflecting to us, right? That in, for example, in XLV, which is continuing to struggle, UNH and Johnson & Johnson are the number 1 and 2 weighted stocks. Is there a reality where XLV moves higher without at least both of those to some degree moving higher as well? No way. Can't happen. And if XLV can't move higher, that's going to be basically sort of a weight around the basically, it's going to be a weight around the S&P and the Dow because that's where XLV is weighted. Now, does the NASDAQ care? Not one bit. So you see how these two lagging sectors, financials and healthcare, don't affect the NAS. The NAS is happy-go-lucky, and it doesn't need to worry about these two corners of the market, while the Dow and the S&P do. UNH is not just over 9%. Johnson & Johnson is 8.5%. Lilly is 7%. Right? Think about just the combined weighting on the overall XLV of just those 3 names. This is why index sector stock matters. All right. So, and we dive into a lot more detail as well as the relative outperformance names, the watch list in the premium video. But let me point out a few other things that I know folks have been asking me about. When are we going to buy bonds? I believe soon. Why soon? We're finally oversold on the slow stochastic. If you don't have an overbought, oversold indicator, one that tells us we've reached a level of a ceiling, one that tells us we've reached a level of a floor, really easy, gang, and it's built into most platforms. Throw a slow stochastic 21K 3D on your chart with an overbought 80 and oversold 20. Listen to me now, believe me later, it just works. I've been using this for over 25 years and it's built into most platforms. But we've got to use it in a neutral environment. Use the multi-trend to understand whether we're in a neutral environment or not, and whether or not it's justified to look at overbought and oversold. ZB, next week, I'll be looking for a long call play in TLT or long ZB. The other chart I've been getting a lot of questions about is gold. Gold's above the 200. Gold's neutral. It was most recently in an uptrend, and now the slow stow tells us we're overbought. I really wanted to get the slew of chuckleheads, the FOMC chuckleheads, out of the way, which we have, so we can start looking at a long position in gold. I like to be long gold and long bonds at the same time because of their connection via real yields. All right, gang, that's what I've got here. I hope it's given you something to think about in terms of your watch list building and really understanding how to use high concentration weighted relative performance to your advantage, right? You can easily decode the market with this. Catch me in Charts and Coffee for our daily conversation about these topics and more. And on Sunday at 6 p.m., you can catch me at the This Week in the Markets live show, which goes live Sundays at 6. Monday morning, the This Week in the Markets newsletter, which you can check out a $7 trial over at thisweekinthemarkets.com. You can check it out there and see more about my watch list breakdowns, sector breakdowns, macro breakdowns, as well as treasuries, currencies, indices, and more. All right, gang, have a great weekend. I'll see you in the next update. Hey traders, Raghi from Simpler Trading. Thank you so much for watching this video. Be sure to leave a like and a comment below. And remember, subscribe and click the bell icon so you'll get notified of the next update. And when you're ready to join me for live trading, be sure to head on over to simplertrading.com. I'll see you in the next update.